We talked last week about, and all year, about a skittish bullishness, nobody going all in. Looks like it's going to a more unbridled bullishness, at least in the last week, and I'll tell you why. I've got three charts to show you. SPY, the Qs, IWM, right? This is that trader crowd risk-on type flows that, again, we've seen this a lot, but it's a little different this time. One is you've got more international and emerging markets action. So let's look at that. International and emerging markets have been the missing link all year, and you're not going into EM unless you're feeling somewhat confident. So you can see the flows here had up to zero for the year, but lately they've been trickling in. Again, a trickle here is a good sign here, and it's also trader ETFs like EM, but also the allocators. So both sides jumping into the international trade right now. And the other chart is just that risk-off and safe haven ETFs are stopping to see inflows because all year those SPY IWM inflows have been coupled with hedging inflows to these more risk-off type ETFs, things like low vol, gold, and fixed income. That is going down, and in fact, it's down here. And in fact, low vol is seeing its first month of outflows all year, right? That's a big, significant sign, Scarlet, that, you know, this might be a little different this time. I've been talking about this sort of like schizophrenic nature here. Could be a regime change. We'll see. It's only a week.
So picking up risk with no safety net now, in other words. All right, let's bring in Deborah Fuhr. She is founder and managing partner of ETFGI, which is a London-based research and consultancy provider. We also want to welcome Rachel Evans, who heads up Bloomberg News' ETF coverage. So, Debbie, Eric gave us his read on flows. You are based in London, so you can offer us a global perspective. Does this apparent rebound into international have legs, or is the U.S. market still the main attraction here?
I think for a lot of people, emerging markets is interesting as well as international. So we're seeing a lot of investors putting money into China A shares because we are probably going to see that being one of the best performing markets at the end of 2019. We're also seeing investors buy Saudi Arabia because it's moved into the emerging market index. Kuwait has moved into frontier. So often those changes cause people to look at these markets because if you don't buy any, you're underweight. And I think an interesting thing, if you look at the end of October data, we're at 401 billion of net new assets going into ETFs. Last year at this time, we were just 379. So I think this year is going to be a record in terms of flows. And right now, we're tipping at 6 trillion of assets, which is pretty exciting. So we're at records in terms of assets globally, US, Canada, Japan, and many of the markets individually. All
right, so new records all around. Rachel, over the past month, we've seen money flow into Europe specifically, and this is despite a range of concerns, whether it's a German recession possibility, the ECB running out of tools, or just Brexit uncertainty. What's going on?
Yeah, I mean, at first glance, it seems a little bit counterintuitive, but we have been seeing those flows. Looking at European ETFs as a category last month, we saw the first inflow since April and the biggest inflow since January of 2018. A lot of that money seems to be going into Eurozone ETFs. The EZU fund that was run by BlackRock and its hedged equivalent took in more than 500 million last month. So a lot of that is kind of going into those. And I think it's really kind of people looking at the situation in Europe and thinking, you know what, Christine Lagarde, maybe she's able to kind of like get some of that fiscal stimulus that the region really needs out. And maybe Brexit, perhaps now that we have the kind of makings of a deal over there, perhaps that's not going to be quite so bad. So people are starting to dip a toe back into Europe. It's not wholesale, everybody piling in, but we're seeing a few initial signs of interest there.
So Rachel just went over the U.S. investors' mindset. You're in Europe. That's where you're based. What's it like on the ground? Are people buying into their own market there? And also, has that new rule MiFID, which is supposed to help passive and ETFs, has it kicked in yet? Seems like it might not have. What's your take?
Yeah, so I think, you know, I live in London, so I think there's still a lot of uncertainty as to what Brexit means and what's going to happen and when do we get there, right? And some people don't want it at all.
Yeah, we could spend all day on this one, yeah.
Yes, exactly. So I'll kind of leave that aside. So I think MiFID II has been interesting. So historically, ETF trades didn't have to be reported. MiFID II required trades to be reported. We thought the trades would be on exchange. What we've seen is most of the trades are being done through RFQ platforms, right? Which means off exchange. So we've seen more trades being reported, but not on exchange. So 2/3 of the trades are done off exchange. And it also means that if you're an advisor, you no longer, if you're independent, can be paid to sell products. So that's been a big change in terms of advisors embracing ETFs, which means retail is embracing ETFs. So the use of ETFs is definitely growing, and investors in Europe are using European domiciled products and less of the US products because of FATCA and because US ETFs are not compliant with a lot of the regulations in Europe.
Okay, so still some growing pains there and adjustment pains. Rachel, your team published a story over the weekend about the pitfalls of zero-cost investing. Sure, it's great news for investors, at least on the face of it, but there is a dark side to all this cost-cutting, isn't there?
Yeah, so this was a great story by Claire Ballantyne that kind of like sort of dug into some of the potential risks of zero. It sounds really, really good, like if you're paying nothing for your products, but there are some potential sort of side effects that you should be aware of. Number one, like people don't do this for free necessarily. So there's a risk that potentially this is either kind of like a way to get people into a fund complex and then potentially be able to upsell more expensive products. There's also potential for issuers to want to do more what we call securities lending, where you lend out what's in the fund in return for a fee. Now that's capped from a regulatory perspective in the US, but there is a potential for you to take more profit from that rather than giving that back to investors. And there's something that I think is a little bit more kind of harder to measure. It's kind of potential corner cutting. Just in terms of like who you hire to create an index, who you hire as a custodian, whether you have a full legal team kind of overseeing all your prospectuses, that kind of thing. It's harder to kind of measure, but there's a potential risk of people kind of trimming back a little bit much. And maybe if we do see kind of a lawsuit or some kind of problem for the fund in the future, that could come back to bite people.
Yeah, it could come back to haunt you, and that's always the problem here. Debbie, what do you think?
Well, I do think the rules in Europe are different than the US, and it is important to remember there are strong legal guidelines on ETFs because they're 40 Act funds or UCITS. But in Europe, you have to give back any of the securities lending revenue after covering the costs of the program, whereas Rachel points out in the US, the manager can keep that money.
Sure.
So I do think there's never a free lunch. Someone's making money somewhere. Either they want to use it as a reason to come and get your account open or something else, right? So
there's always a cost to it no matter what.